Okay, hi everyone. So I'm Wildy Chia and you're watching this on my YouTube channel. Right. So today's topic is on decision making, and the specific area of decision making is relevant cost. I think it's interesting to look at this. I mean, as a student, especially if you're an accounting student, you'll have to go through this topic of decision making and what is relevant cost. Right. So let's have a look at the scope for today. Right, for today's session, we are going to look at the different types of decisions made by businesses, and then after that, to understand and explain what is the concept of relevant cost, and how do we apply relevant costs to, in simple decision making, right? And after that, conclusion. So, when we talk about decision making, what kind of decisions am I referring to? Alright, in the typical accounting textbook, decisions will be referring to those that may involve making or buying. Alright, so if you're running a factory, then one of those decisions that you have to make is whether you want to produce the order within your factory, or would you want to buy it from an external supplier. So businesses make decisions like this. They make a variety of such decisions, and make or buy is one of those decisions that businesses make from time to time. Another is special one-off orders. Alright. Now what do I mean by special one-off orders? Certain customers may require their goods to be somewhat customized. Right. So customized production, which comes by from time to time. For all kinds of reasons. So in looking at whether to accept these special orders, then businesses need to decide whether it's commercially viable, whether it's economically sensible, right? And one more is the decision to upgrade equipment, or maybe to expand. So we have decisions such as these, and there are many more other types of decisions, right? But today we are just going to look at a few of these simple decisions. So whatever the decision that is to be made, these have to be systematically assessed, right? So it's not like, that the business owner should use gut feel to guess what kind of decisions to make. There should be some form of systematic process to help the decision maker make a very rational and informed decision. So as such, it's very necessary to make these decisions using financial figures as the basis. Right. Using financial figures as the basis, then decision makers should arrive at their conclusion, whether to make a decision or otherwise. Let's look at a very simple example of a decision making process. Right. John is an owner, or the owner of a business producing a certain component X for handphones. It has excess capacity to produce more component X. Now the variable cost of producing each unit is $4, selling price $6. Now which means that from producing this regular units, the contribution is 6 minus 4, which gives $2. So it's a fairly attractive, maybe not fairly attractive, so it's a fairly regular thing for John to earn $2 of contribution per unit produced and sold. So a certain customer came and said that he would want to have a special production run, a special order of 100 units of X, but these are slightly modified. Okay, the variable cost as such is slightly more expensive. Selling price is of course higher. Now for this case, the contribution becomes 9 minus 5. This then gives $4. Now obviously when you look at this, what does it tell you? It tells you that the special order is definitely worth taking up because the business has excess capacity, and that the contribution is higher than the regular orders. So why not? Okay, now you notice at this juncture you have realized I have actually neglected, I have ignored the production overheads. Why? Because for short-term decision making, production overheads are not relevant costs, right? Because whether an order is accepted or not, the overheads still occur, right? So such numbers like overheads, fixed costs, we generally ignore them for purpose of making decisions, alright? And for purpose of assessing decision to make or buy, that's what we do, right? We ignore overheads, right? And the fact is, these occur whether or not the order is accepted or otherwise. Okay, so that's this, right? So you have to be very careful if you approach this in the exams. Let's make sure that you systematically ignore such items like overheads and fixed costs. Right, of course that also depends on the context. Right, the context will also give you more details about whether an overhead or fixed cost should be ignored. Right, I mean, depending on the situation, it might be a bit different. Right, because usually fixed overheads are not relevant, but there are cases that fixed overheads can be relevant. Okay, but for the purpose of this video, we are not going to discuss that. Okay, just take note, it can be possible that fixed overheads are relevant costs. Okay, so that's possible. Okay, for example 2. Okay, now I have changed the example a bit for example 2. Now the question has been changed to, what if there is no excess capacity? Now if there is no excess capacity, then, and the figures here that you see are quite the same as the earlier example. Right, the contribution for the regular orders is still $2. Contribution for the special order is $4. Now in such a case, there is no excess capacity. Now same thing, we also ignore the overheads because these are not relevant for purpose of decision making. Right, so since there is no excess capacity, how can the business go on and accept this special order? How can they do so? Well, the business is only able to accept the special order only if the business turns away some of the existing order, then take up the special order. So this is the situation. Now in this case, do you think that it's worthwhile for the business to turn away some of these regular orders? Well, obviously it makes sense because the regular orders only gives like $2 a contribution, but whereas this special order gives $4 of contribution. So the right thing to do is to turn away some of the existing orders and take on the special order. Now there is one issue. They would actually end up upsetting the existing customers, because the existing customers are going to get a bad surprise that their orders are cancelled all of a sudden. So there is also this thing to consider. Is the business prepared to upset the existing customers and tell them to go away, and then at the same time take on the special order? It's quite a tough decision to make in this case, because if you're going to tell the existing customers to go away so that you can take the special order, these existing customers may never come back. That is a serious problem. Okay, but in business sometimes there is this very difficult decision to make, whether to continue to entertain existing customers or whether to take on the better margin orders. Okay, but when you start to take in all these higher margin orders, you end up upsetting, neglecting the earlier customers, which can be quite bad, right? And in today's modern economy, if you're going to tell the customer to go away, chances are that these customers may never come back. That's serious. Okay, so let's look at example 3, another type of decision making question. Now this question is a bit different. Now what it says here is that same thing, the business has no excess capacity to produce more of component X, right? The contribution for the regular orders is still the same. 6 minus 4, you get $2 contribution. Same here. The contribution from the special order, like the earlier question, still remains at $4. Now the production overheads remain not relevant or irrelevant for purpose of decision making. Now there is something interesting. For special production runs, it's quite understandable that certain additional customization may be required, like special packaging. So this special packaging may in fact increase the cost of fulfilling the order. Now in this case, the contribution is going to be a bit different. The contribution from this special order would therefore be 9 minus 5, the variable cost, and minus 1, the additional special packaging, right, which costs $1 per unit. Now 9 minus 5 minus 1 gives you $3. Now in this case, if you compare, the regular orders only gives $3. The special order, even after taking into account the $1 of cost for special packaging, contribution still remains at $3, which is still higher than the regular orders. So is it still worthwhile for John to accept the special order? The answer is yes. Right, even though there is an additional cost for special packaging, but then the net contribution is still worthwhile for John to start to turn away existing customers and take on this special order. It's still worthwhile. Okay, so that's this. So in this case, we realize that relevant costs that we use or apply for purpose of decision making includes avoidable costs. Avoidable cost basically is a cost that can be avoided by making a different decision. Like for example, if I choose not to accept the special order, can I avoid paying for the special packaging? Yes, I can. And another example of relevant cost is opportunity cost. Opportunity cost arises when you have to turn away customers. Now when you turn away customers, the loss in sales, the loss in revenue is an opportunity cost, right? Let's look at one more example, example 4. So example 4 is a slightly different decision making, right? It's no longer about buying and selling or or to fulfill certain special orders. Now in example 4 is quite different. It says here that John again produces a certain component X. So right now he uses a certain machine Z or Z to produce this electronic components. The maintenance cost is $400 per month. Depreciation is $300. Now, and he is planning to purchase a machine Y to replace Z. This new machine Y will be more efficient and production output will be higher, but the repair maintenance cost is expected to increase. At the same time, depreciation is slightly higher. Right. So what is the relevant cost that John should consider in his decision on whether to upgrade the machine? Now in this case, there are only two figures to take into consideration. 500 for the maintenance of the new machine, 400 for the old machine. Now do we need to take into account the depreciation? Not necessary, because depreciation is an accounting expense. Alright, and these are not real cash expenses. Okay, so we ignore such items as depreciation in our decision making process. So therefore you only consider 500 and 400. So the relevant cost that John need to consider is the additional 100 if he were to choose to upgrade the machine. Now this 100 is also better known as differential cost, right? Differential cost, or sometimes we use the other term, incremental cost, right? So there is an incremental cost of 100. Would it be worthwhile for John to upgrade the machine? Well, then that depends on whether the incremental revenue can cover these incremental costs, right? Example 5. Okay, so John had received a certain order, right? So a customer sent in a request and asked for this certain M component to be produced, or rather they want to purchase this component M. John found out that if he is going to produce in-house, the variable cost per unit will be $3, but if he is going to look for an external production factory, or maybe an external supplier, the cost will be $3.50. So now this is very obvious. If you were to take $3.50 minus $3, that is 50 cents. So the incremental cost of buying from an external supplier is actually higher. Right? If you buy from an external supplier, you have to pay 50 cents more per unit. So the obvious answer is John should not purchase from the external supplier. Okay, he should not turn to external supplier. Right. So instead, John should produce component M in-house, because if you have to produce in-house, it's cheaper than going for outsourcing. Right. So you can see that there is quite a variety of different decision-making situations that can arise. Okay, so in this case, we realize that some examples of other types of relevant costs includes incremental costs and differential costs. Now, decision making is not solely based on revenues and costs. It has to also take into consideration non-financial aspects. One example could be like, for example, reliability of external supplier. Right. Now, the business may be interested to turn to an external supplier for the goods and services, but reliability is very important. Can the supplier be trusted to deliver the goods and services on time and as and when required? Now, that is quite hard to tell, right, until you have started working with this external supplier. Quality issues. Now, quality issues can be very hard to manage if you have chosen outsourcing. But if it's in-house, it's easier to manage quality issues. Okay, next, in-house competencies. Right, in many cases, it's quite attractive to produce the goods in-house. Right, because if everything is produced in-house, you could control quality, you could ensure that costs can be controlled. However, to be able to produce in-house, right, one of the very important things to consider is whether there are people with the right skill set to produce the required goods and services. Right, competencies can be very hard to acquire. Right, and for example, if you wish to produce certain customized goods in-house, it may not be very simple because your staff may need a certain amount of learning curve before they are able to produce the goods and services efficiently. Right, so this is quite an issue. You know, when deciding between making or buying. Right, and finally, the also quite important is whether there is excess production capacities. Right, only when there is excess production capacities then can the business owner decide and consider if, let's say, the production can be done in-house. Right, Otherwise, if there is no excess production capacities, then basically there's no choice except to outsource the production. Closure. So what are relevant courses? Relevant courses are those courses that we use for purpose of making short-term decisions. So such courses include those that are avoidable, right? These are courses that occur in the future, right? Not in the past, in the future only, right? Past is not relevant. Incremental costs, and also finally, opportunity costs. These four are some of the traits of relevant courses. And other considerations that we have, non-financial considerations, include, like what I mentioned just now, the quality of the, not just quality, but reliability, as I mentioned. Right, the reliability of the supply is very important, right? And then I mentioned to you the in-house competencies. So it's not as simple as, pressing the button and say that, okay, let's go for outsourcing. It's not that simple, right? So there are various non-financial issues to consider and ponder over. Okay, so I hope that has been informative. I'm Will Dicha, and you have been watching this on my YouTube channel, right? Thank you for watching and have a great day. Thank you.